Axis Bank's earnings report for the quarter gone by reflects the lender's continued focus on creating a high-quality balance sheet, thanks to adequate provision, recognition of COVID first wave stress, readiness to grow with granular asset liability and adequate capital, and better preparedness to face the near-term challenges of the second wave of the pandemic. Despite market volatility, the stock has outperformed both the benchmark Nifty and the bank index in the last 3 months. While near-term gyrations cannot be ruled out, any correction would be a good opportunity to add Axis Bank, as it will be rendered stronger compared to most competitors in the post-pandemic era. The reported pre-provision profit growth was healthy thanks to the support from interest as well as non-interest income. Interest margin showed a tad decline on account of tax refund benefit in Q3 and excess liquidity in the balance sheet in Q4. Talking about the asset quality, upfront recognition of stress and healthy provisioning have put the bank on a strong footing. COVID provisions to the tune of 5,000 crores provides a good armor to face the near-term challenges posed by the second wave of the pandemic. The bank continues to adopt a very conservative policy of upfront recognition of stress and has restructured a minuscule quantum of loans of about 1848 crores, about 0.3% of gross customer assets. The overall loan book grew by 9% YOY and growth with TLTRO investments was about 12%. The growth was supported by all the key segments of retail, corporate and SME, and there's high distinct shift towards high quality for corporate SME as well as retail, with 81% of the retail book being secured. Of the unsecured retail book, which is close to 10% of the bank's advance, a large part is to salaried and bank's existing customers. The high quality is also getting reflected in low ratio of risk-weighted assets to total assets that has been trending down and stands at 64%. Now the big question is, will it compromise margins for quality? Thanks to the excellent liability franchise, Axis will maintain and gradually improve margins despite hyper-competition in the high-quality asset space. While overall deposits grew by 10.5% in Q4, retail term deposits plus CASA grew at a faster pace of 16.5% YOY. The strength of the liability has resulted in steady reduction in its cost of funds by 110 basis points in the past 1 year to a very competitive level. It is the strength of the funding cost that will aid the bank in garnering market share without compromising on the quality of assets. The bank has also built a granular fee business with stable retail and transaction banking fees constituting about 82% of total fee income. It appears to be doing a commendable job on the cost front as well, despite spending heavily on technology, with its cost to income ratio at 42% and cost to assets ratio falling below 2%. Post 2 rounds of capital raising, the bank is sitting on a healthy capital adequacy ratio. Given the weak balance sheet and inadequate capital for a large section of competitors, especially public sector banks, Axis is in a vantage position to aggressively grab market share. Axis Bank has successfully negotiated COVID-1 and has now the balance sheet strength to face COVID-2 without much hiccups. The return of the pandemic might be a speed breaker, postponing the growth by a few quarters, but certainly not a derailment. With adequate capital and superior liability, it is in a vantage position to accelerate the growth pedal post-COVID. With the superior quality of earnings, once growth resumes, it is only a matter of time before the valuation multiples re-rate. Let's talk about the risks as well. The unexpected disruption due to second wave of COVID resulting in poor growth and substantial worsening of asset quality do, however, continue to remain some important risks to watch out for.